Hey folks, Brandon here from the realestateCPA.com. Going to be chatting about backdoor Roth IRAs. The backdoor Roth IRA contribution is a secret tax loophole that high earners use to put money into a Roth IRA when they're phased out of making basic Roth IRA contributions. Basically, at a certain income level, you're no longer allowed to contribute money to a Roth IRA. So the backdoor method allows you to open up a traditional IRA, put money into that traditional IRA, and then roll it into a Roth IRA. Now, the money that you're putting into the traditional IRA is considered a non-deductible IRA contribution. Once that contribution is made, you then have an amount in a traditional IRA that you can then roll into the Roth IRA, and that's how we get the money into that Roth IRA. Now, this only works if you don't already have traditional IRA balances. If you do have a traditional IRA balance, what's going to happen is your non-deductible IRA contribution is going to be prorated, meaning that if I already have traditional IRA balances and I make a non-deductible contribution to my IRA and then roll it into a Roth, just because the money's in the Roth doesn't mean that the entire amount of the rollover is going to be considered that tax-free rollover. There's also some timing issues here. So we don't want to roll the traditional IRA right into a Roth immediately after making that contribution. Instead, we want to wait a period of 12 months or so. And the reason is there's something called the step transaction doctrine, which basically allows the IRS to say, hey, you really just meant to make a contribution to a Roth IRA, so we're going to disallow this middle step that you took, which was putting it into a traditional IRA just to throw us off our trail. If you have any questions about IRAs, 401ks, or backdoor Roth IRA contributions, hit us up at the Real Estate CPA. We really do love this stuff and we're happy to help you navigate the tax laws.